The consumer still has a ton of debt. Corporations are socked in debt. The United States of America is loaded in debt. If you look at total debt of this nation as a percentage of the economy, not in nominal terms. In nominal terms, it's off the charts. But just look at it as a percentage of GDP. It is the same level, the same ratio that it was just prior to December 2007 when the economy fell apart.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always delighted to have this well sought after returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He's an active money manager who's highly anticipated by our viewers, and he joins us again this Thursday, August 4th, 2022. Michael, thanks for coming back on Liberty and Finance.
Love to be on with you, Dunnigan. Thanks for having me back on.
It's been a little over a month that it usually is between visits here, and my gosh, it seems like longer because so much has gone on in our financial world. Those of us who aren't paying any attention probably just notice prices going up around the place, but those of us who are paying attention, it has been a blizzard, a snowstorm of like unprecedented things going on, both domestically and internationally in the financial markets, in the financial management of things, that sort of thing. One of the people who we've often had on, Gregory Mannarino, and you are often looking with different perspectives, but similar in some veins of major events that are happening. And one that's happening now seems to be strains in the credit and debt markets, and some interesting inversion of the yield curve and mysterious dropping of the 10-year yield and that sort of thing. There's a question here from a viewer that I thought you might be able to respond to that would kind of take us into that. Troy Johannesson says, Gregory Mannarino is currently stating that the Fed is buying the 10-year yield in an attempt to stabilize the debt market and prevent a credit freeze. In your opinion, will this work? And does this change the way we should look at risk for the near term?
First of all, I have a tremendous amount of respect for Greg Mannarino. Him and I are friends, and I think he's a man of impeccable character. So let me just preface anything I say, whether I disagree with him or not, and I mostly agree with him on most things. So let's just talk about what's happening right now. Not much has changed since the last time we spoke, other than the volatility in the market, where vicious bear market bounces are very painful, and they bring out the FOMO, the fear of missing out, in everybody. I mean, it's a natural impulse. But the facts are the facts, Dunnigan. Since the start of this year, the NASDAQ is down almost 20%, and the S&P is down about 14%. That's a pretty bearish trend. Phase one of the correction, in my opinion, was about a multiple contraction. And why did we get that multiple contraction? Excuse me. It was simply because the Fed was going to have to raise rates aggressively into record high inflation. So stocks anticipated that move, multiples contracted. We are now sort of maybe at the tail end of a vicious bear market rally. But that is all that it is, because the credit cycle, the liquidity cycle are still deteriorating. Phase two of the bear market should be commencing, like I said, any moment now, maybe next week, maybe next month. But the fact of the matter is this, that the next phase is going to consist of an earnings contraction due to the recession. And yes, we are in a recession. 2 back-to-back quarters of falling GDP growth is a recession. 1.9% in Q1, 0.9% in Q2. And on top of that, and you can argue with me if you say, well, the employment structure is still sound and consumption is still good, whatever baloney you want to say. You cannot argue that the economy is now fundamentally strong because of those two back-to-back quarters of negative growth. And into that negative growth, you have the most hawkish Federal Reserve since Paul Volcker, and maybe even in the history of the Fed.
Well, you described the Fed's actions as, or they need to get really hawkish against inflation, but it's people who have been talking about the real rate of inflation being significantly north of where the Fed's actions have been in response seem to say that the Fed's response is far from hawkish. Can you talk to us about whether you think that their fractional percent increases in interest rates that they've been doing are going to be meaningful at doing anything to tamp down real inflation?
Well, yes. I mean, I do believe inflation is in the process of peaking. I believe we're going to have a period of disinflation. I mean, I'm not arguing that prices are coming back down to where they were pre-pandemic. And you have to define what inflation is. It's rate of change. It's the first derivative. I'm saying the second derivative of that change is going to be lower than it was in the last print of 9.1%. That's all I'm saying. So inflation going from 9.1 to 7 something percent, perhaps by the end of this year, is disinflation. It's not deflation. It's not falling prices. It's prices that are rising at a slower rate. That's a fact, in my opinion. That's what's going to happen. And the reason why it's going to happen is look at the growth rate of money supply. M2, the growth rate of M2 is crashing. And the government stimulus checks have stopped arriving in the mail for the most part. You have some ancillary states, I think there's 15 states sending relatively smaller amounts of stimulus, but that doesn't counteract the fact that the Fed is going from 0% Fed funds rate to 3.25% to 3.5% by this year. Now that's a pretty significant rate of change on interest rates, no matter how you slice it. Okay, 350 basis points in 1 year is a whole heck of a lot. I don't care if you're talking about Jerome Powell or Paul Volcker. And on a percentage basis, it's the fastest rate of change we've ever seen before. And on top of that, what we're supposed to be seeing, and I am not trusting this, I am distrusting it, but verifying it, is I want to see the balance sheet being reduced as to the level and pace that Jerome Powell said he was going to reduce the balance sheet. Balance sheet so far has had very little reduction. Maybe I think $45-50 billion from the high. It's supposed to be $47.5 billion per month. This was supposed to start in June. We are now in August. So there's something going on. In fact, here's what I wanted to say. This is such an important point. I doubt you hear this anywhere else because Wall Street is made up of a bunch of cheerleaders. But listen to Powell's press conference. He was actually asked a question about the balance sheet. And what he said was, he gave us some gobbledygook about trade settling, but he said it's about to ramp up significantly. It's going to jump to $95 billion a month in September. And then he said this in response to a reporter's question. He said that the balance sheet will take 2 to 2.5 years before it reaches equilibrium. QT will have a duration of 2 to 2.5 years at the pace of $95 billion a month before the balance sheet reaches equilibrium. That's from his mouth. Now, I'm mistrusting and verifying. But if that's the case, if we're going to go to 3.25% to 3.5%, right now the effective Fed funds rate is I think it's 2.3 right now, effective Fed funds rate. If we're going to go from 2.3, 2.2 and a quarter, 2.3 to 3.25 to 3.5, plus drain almost $500 billion of money supply between now and the end of the year, that is the most hawkish central bank in history, and it exists in the context of, and we can debate this all you want, but in what we have to agree on is a very weak U.S. economy and an extremely weak global economy. Don't forget, we have Bank of England saying today that we're going to have a recession throughout all of 2023. GDP in the Eurozone is slated to contract later this year. Japan is contracting. The US is contracting. China's manufacturing base is contracting. So you have a very, very weak construct and some of the most hawkish central bankers in history. If you want to fight the Fed and fight the business cycle and the liquidity cycle, you can do so and get all FOMO'd up about a bear market bounce. But for me and my investors, we are going to be patient. We're going to stay safe. We will cover shorts and go long panic bear market sell-offs, not try to get caught up in the fear of missing out.
How about the 10-year and 2-year inversion, that sort of thing? Watersport 86 says, ask Michael if the Fed is purchasing the debt market. How are they doing it if it's not on their balance sheet? Speaking of the balance sheet. And if not, why is the 10-year dropping like crazy?
Well, because, like I just explained before, listen, the Fed is going to raise, Fed controls short-term interest rates. They do not control long-term interest rates unless they're actively purchasing those bonds. And we can see from the balance sheet that they are not actively purchasing long-term duration bonds any longer. So they're raising the Fed funds rate. That tends to elevate short duration treasuries, so anywhere from 0 to 3 years. And yet, because they're so aggressively fighting inflation, the longer end of the yield curve, which is most concerned about growth and inflation, is saying, hey, we are headed for a period of, on the second derivative basis, slowing inflation, disinflation, and a recession. So people crowd into the longer end of the yield curve. And the yield curve right now is more inverted today. I think it's 35 basis points, depending on the moment you look at it. Negative 35 basis points between the 2-year and 10-year note is more inverted than it was at any time leading up to the global financial crisis, just before the global financial crisis. So you have a very inverted yield curve. It's becoming more deeply inverted, and it's presaging recession and disinflation. Not deflation yet, disinflation.
The consequences of a protracted and deep recession can be quite serious, not just ordinary people in their ordinary lives being laid off, losing their income, potentially losing their home, different things like that, but also to the banking system. I know that Alistair McLeod has talked with us about the fragility and the high gearing or the high leveraging of the European banks in particular, also the Japanese banks, and to a lesser extent the U.S. banks. But if you start to have a lot of business recession causing lower earnings, some business closure, failure, retraction, you can end up with non-performing loans, etc. On the commercial side, very potentially damaging to the banks. So I wanted to talk to you about that. The credit market. Entanglement Entropy, interesting name, asks the question, we need to hear from Mike right about now. Mike, Jamie Dimon recently warned us about an incoming hurricane. Does that mean a credit freeze? Do you agree? How soon?
Wow. Well, that's a great question. So when people say that's a great question, that means that it's going to be hard to answer specifically.
We don't have you on here to ask easy questions, so there you go.
That's very clear. Yes, I do expect the credit market to freeze. Now, first of all, Jamie Dimon at the start of this year said this would be the best economic growth that the United States has ever seen. That's what he said in January, okay? Then a few months later, when the market crashed by over 20%, it was an economic hurricane. Doesn't know if it's going to be a Cat 1, Cat 5, is going to slam into the United States. He doesn't know. But the way I look at things is I see a credit crisis coming. If one does arrive, it'll be late 2022, early 2023. And it's all predicated on if the Fed prosecutes on their plan to continue to hike interest rates to fight inflation and actually prosecutes on their plan to drain the balance sheet. Now, there's a lot of reticence here. I'm so glad Powell got asked that question about the balance sheet. And he stammered and stuttered, as he usually does, and cleared his throat a few times. But he said the trade, the way balance sheet, the trade settled. But go and look at the actual interview and the question. I think it was about 30 minutes into the Q&A section. He said something about trade settling, and he admitted that it had a slow start. But now he says it's going to ramp up significantly and last 2.5 years at that pace of 95 billion. That's more than double the pace of the last quantitative tightening program. And we all remember what happened in 2018. Okay, so the Fed was hiking rates in 2018. They got to 2.5%. When they hit 2.5%, Powell had to say, okay, we can't do this anymore because the Russell 2000 dropped 30% between Halloween and Christmas.
Yeah, we had the worst December ever. That's right.
First December, and that was at 2.5%. Well, guess where the Fed funds rate is now? But it's right there. You're knocking on the door at 2.5%. And at that time, QT was $45 billion a month. Well, now it's going to be $95 billion a month in September. So we have the very high likelihood, and the economy was stronger back then too, and not anywhere near as amount of debt that we have outstanding. So if you look at, people always say, oh, the consumer is so strong, corporations, blah, 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 their balance sheets pristine. Shadow banks' balance sheets are a mess. The consumer still has a ton of debt. Corporations are socked in debt. The United States of America is loaded in debt. If you look at total debt of this nation as a percentage of the economy, not in nominal terms. In nominal terms, it's off the charts. But just look at it as a percentage of GDP. It is the same level, the same ratio that it was just prior to December 2007 when the economy fell apart. So I don't want to hear anything about, well, it's the government, it's the government's debt. Well, no. The government's debt is our debt. The government doesn't have any money. If they want to finance this debt, they have to sell a bond to us, to the public, or they can print it. That's the only two ways, and they're not printing money right now. So that their debt, government debt, is our debt that has to be serviced at a specific rate. And by the way, the Fed, like I said, the Fed was a week ago at 1.6% Fed funds rate. So now you're at effective Fed funds rate at about 2.3, 2.4. These interest rates don't just exist in the netherworld. And this is a prime lending rate. It's the overnight interbank lending rate, but also is the rate that affects a whole heck of a lot of loans, including car loans and credit card loans and student loans, adjustable rate mortgages. So there's a lot of effects yet to happen with this interest rate hike that just happened. And we're going to pile another 50 basis points in September, and then another 25 and another 25 in November and December. So to believe that this is all priced in and we should get excited about a bear market bounce, I mean, go look at what happened in 2001, 2008, or 2007. When the Fed started to ease in 2000, they started easing monetary policy in December of 2001. Did the market bottom at that time, Donegan? No, it didn't. They cut rates in 2001, and the market fell 40%. The Fed started cutting rates. Bernanke started cutting rates in the summer of 2007. Cutting rates, not stopping to raise interest rates or stopping 75 basis point rate hikes and going to 50. He was cutting rates. If you bought stocks in July of 2007 on the predicate that the Federal Reserve was coming to the rescue of the business cycle, that would have been a big mistake because the market on the S&P 500 sense lost 50% or more. It's between 50 and 60% since that July first rate cut. So the Fed has a lot of work to do before I would get interested in getting more inclined to cover shorts and to go long risk assets willy-nilly without any kind of hedges. Just because the Fed is going from 3 hikes in three 25 basis point hikes in one meeting to 2, maybe 2, that is not reason to couch Mr. Powell as being a dove. I think that would be a very big mistake.
How about on the international front? The U.S. dollar has been the world reserve currency since Bretton Woods, 1944, and that's been kind of the backdrop for a lot of our ability to set bond interest rates and things like that. and know that, well, you've got it. Foreign takers have to still buy the bond because they got to use dollars for all their trade and so on. There's a question here from Sarge 27271. It says, can you talk to us about the BRICS momentum? That's, Brazil, Russia, India, China, and arguably South Africa, Saudi Arabia. It seems like there's more Turkey. There's a lot of people trying to jump on that train to bring about their own version of a reserve currency.
Yeah, well, there's no doubt about it. This is a long-term trend of foreigners getting out of dollar hegemony. This is no deniable. This is an inexorable trend that's been happening since really the 90s all the way till today. Now, when I think about the dollar, I think about the dollar vis-a-vis the euro, yen, pound, renminbi. What is going to replace the dollar as the world's reserve currency? This is how I think about it as a trader now. What is going to replace the dollar as the world's reserve currency in the next few quarters? Well, nothing is. There's nothing that's going to replace it. So if your argument is over time, will the dollar lose its world's reserve currency status? Absolutely. If you're asking me if I'm going to go long the euro, which is really almost half of the DXY, the Dixie, if I'm going to go long the euro today over the dollar, given the fact that they have a very steep recession in front of them, they're way behind the Fed as far as raising interest rates. So the interest rate differential is far in favor of the United States. They're going to have their gas. Well, they've had Gazprom is shut off. I think they're down to 20% now. They might not have any gas for the winter. And that is in the context of an extremely weak economy that's getting much weaker. Now, I'm not saying the United States isn't getting weaker. The United States will become very weak. But relatively speaking, and that's what currencies are all about, relatively speaking, the dollar is stronger, has been since I went long the dollar in March of 2021. And that's been a staple in my portfolio. I will sell that when the Fed capitulates as the recession in the United States begins to become manifest. At that point, you short the dollar and go long other currencies. I'm not saying particularly long the euro, but you could buy a lot of emerging market stocks at that point, in my opinion, which are denominated in foreign currencies. The dollar will get weaker against, say, Chile or Brazil, Argentina. But right now, it would be a mistake, in my opinion, because when the world hits a crisis, and we're almost in the middle of this crisis and heading into the steeper part of this crisis, which is the fall and the winter of this year. People flock into two things, primarily. They love the safety and security of the US dollar because there's unwinding of carry trades that occur. So they flock into the dollar, they flock into US treasuries, and those are the two things you have to own if you want to have any kind of alpha in your portfolio.
Still on the topic of dollar alternatives, we have a question again from Sarge 27271 who says, what does Michael think of India this last week launching its first international bullion exchange? Reuters article will include in the description. So China already had an international bullion exchange, the COMEX in New York, the LBME in London, but India now is taking a step of an international bullion exchange. Do you see an expanding role evidenced for gold in international financial affairs going forward?
Yes, with an exclamation mark. Now, we talked about currency trading, dollar vis-a-vis other fiat currencies. Let's talk about dollar vis-a-vis gold now. Now, I have been a big bull on gold throughout 2021. I took that position down to 5% several months ago. It was absolutely the right thing because you'll see gold didn't really go anywhere. I think it was down about 5% this year. Gold stocks, miners got crushed this year. So my timing there was pretty good. I do get some things right once in a while. My timing, I think, is going to be impeccably good on the upside here with gold miners and gold. I plan on increasing my position dramatically as we see the recession, which is already manifest. You might have a quarter here where you have one positive quarter. Q3 might be mildly positive, maybe. But then after that, and a lot depends on what Jerome Powell does with that balance sheet. because destroying base money supply, in my opinion, is even more deflationary and disinflationary than raising interest rates. But I see a great opportunity when the Fed has to capitulate and come to the rescue of this and genuinely come to the rescue of the credit markets, which they have to do. Once the credit market freezes, the Fed doesn't care where inflation is. I mean, they'll be reticent now. Here's a point that you have to get into your head. Since we have just come off 9.1% year-over-year CPI, headline CPI, the Fed is going to be very reluctant and reticent to go back into QE and to cut rates. It's going to take them a longer amount of time because they know what's going to happen. You're going to have stagflation as far as the eye can see. So they're going to drag their feet and talk up the economy like they have done in the past. You know, they wheeled out Jerome Powell and even Janet Yellen. Of course, Biden was talking how, you know, you can't tell me this is a recession. Well, you know, thanks, Joe, for your opinion. I really doubt you can understand cognitively what a recession really looks like any longer. So, and I'm not trying to put the man down, I'm not going to use his opinion on whether or not the economy is in a recession. But these people are forced to talk up the market because they have no other alternative. They know they have to hike interest rates aggressively into a recession. So they're left with only one alternative: talk things up.
We've got I'm keying in on your theme that the drum you've been beating pretty loudly is about major recession. And there's a question here from a viewer on that about Mike Bender says, you've noticed many online retailers do not offer businesses to Minnesotans given the state regulations there. And how are would you be able to inform us of these regulations and how that impacts us as Minnesota citizens? So we just saw a story come out on today that GEICO, a major insurance company, abruptly closing all of its brick and mortar stores in California, laying off tons of people there. There's these jurisdictions, in addition to everything else you're talking about financially, monetarily, there are policies of restricted requirements that have been imposed in certain jurisdictions that have really put a added cost and difficulty. Sometimes it's even a matter of companies saying they can't provide safety for their employees in these physical locations in some of these states. Can you talk to us about what you're watching as far as different areas of the country, for example, that may or may not be impacted more severely by this recession than others?
Well, when you ask a question like that, I automatically think of real estate. Where has the real estate market appreciated the most? If you look at the Sun Belt, where I'm in Florida, if you look at parts of the Northeast, parts of the West, Colorado, I think they face a big problem in the real estate market. I think that the consumer is under a lot of pressure. If you look at AT&T, announced that their customers have, for a good percentage of them, have just stopped paying bills. Comcast announced that they're losing subscribers. And it makes perfect sense because the middle class is taking this right on the chin. If you look at the middle class and their 401k plans have been wiped out, a fifth of that 401k has been wiped out. Their real wages are plummeting. They're actually relying on credit cards now more than they have in a very, very long time, piling up debt on credit cards just to try to maintain their standard of living. So I think we have yet to see. We saw the bond bubble implode. High yield started to implode. And by the way, that implosion isn't over. I'm saying that it started. High yield debt started to implode. We saw Fed funds rate rise dramatically. That's not over yet either. The bond bubble and sovereign debt on the long duration, that's over. I think we've seen the top end of interest rates on the long end of the yield curve. But everything else outside of that is in the middle of its implosion. The equity market, phase one is over, 20%. I think there's another 25 to 30% at a minimum to come, not in total from here. And it could be much more, again, depending on how fast inflation drops, how deep the recession is, and Powell's response. And then, of course, the real estate market. Home price to income ratios have never been higher. And you can tell me that, the underwriting standards are better and, people have more equity in their home than they ever have before. Well, yeah, all that is true. But home price to income ratios, the affordability level of these homes has never been worse. And when you have 1 in every 5 homes owned by an investor, there's a significant amount of latent inventory that's going to come on the market. So that's the third leg of the triumvirate of bubbles that's going to burst, all at the same time. And that's going to cause shadow banking market to freeze. It's going to freeze credit markets, and it's going to bring powell back to the rescue, I think, later this year, early 2023. And all the while, you cannot have an implosion of the greatest 3 asset bubbles in history, stocks, bond, and real estate, imploding together and have a soft landing. It's just not possible. So again, for those who are buying this stock market without any kind of protection, in the fear they're missing out on the next big bull market, be careful.
One more follow-up question related to gold, and this has to do with what you were talking about with the world reserve currency status for the dollar. Cleta Smith says most of those comparisons of gold maintaining its purchasing power historically occurred when the dollar was the reserve currency. But what happens should the dollar cease being the world's reserve currency? When it loses that status, will it be devalued substantially, so its buying power will plummet? So will gold just retain its value in the new world reserve currency, or will it demonstrate a outstanding benefit over the devalued dollars, or just maintain its buying power?
Well, it depends how you measure it. You're measuring gold in dollars. Gold's going to soar in dollar terms. Dollar's falling, you get inflation, and the dollar crumbles, and gold maintains its purchasing power. So that's the beauty of gold. This is why it's such a great investment. And you always should have at least 5% of your net worth in gold. And it's a parking place for your wealth. It's not really even an investment. Investment is something that returns an after tax, after inflation, real return. That's not what you use gold for. That's what gold miners can do. That's an investment. Gold is used to preserve your purchasing power. So as the dollar crumbles and inflation ticks higher here in some kind of future stagflationary environment, which is, by the way, where I think we're headed in the out years, middle of this decade and beyond, severe, trenchant, protracted stagflation is, I think, what the U.S. is in store for. Gold's going to be fantastic. But as far as giving you a return over inflation, no. It is a parking place of your wealth. It's a way of preserving your purchasing power, period.
Michael, if people want to take advantage of your other services, both your publications, you put out a weekly sanity check. Reality check, there you go, every Wednesday. And you also provide active money management services to keep people on the right side of this crazy upside down world. Can you tell us how people can get a hold of you about those?
So the website is pentoport.com. I'm a registered, SEC registered RIA. If you have $100,000 to invest and you're a U.S. citizen, you could always give us a call at 732-772-9500. You can email us on the website through the contact page. My personal email is mpento@pentoport.com. Either me or one of my staff members will get back to you, probably me, if it's a good question. So I also have like you said, a sanity or reality check. It's called a midweek reality check. I put that out every Wednesday night. It's $50 a year. And you have a 5-week trial period. I just look at all of the relevant data, and bullish or bearish. By the way, I have to remind people, I am not a perma anything. I don't permanently own half of my portfolio in gold. I'm not always short stocks. I tend to be able to participate in bull markets very well. Thank you very much. I also have a very good track record of protecting from bear markets. So if that's something that interested you, then please reach out to me. We specialize in customer service, excellent customer service, and truth and honesty, and treating the clients the way they deserve to be treated, which is actually the antithesis of Wall Street. We're just primarily made up of salespeople who have no ability, by the way, no ability to raise significant levels of cash during a bear market. They cannot short stocks because you can't short stocks in an IRA. I go long ETFs that go up when the market goes down. That's one of the ways I protected my clients for the most part during this debacle of 2022, and it's going to get much worse. Phase two of this debacle is going to be one where bond yields fall, prices rise, and that's not a signal for you to go long stocks. It's going to be a signal that the recession and depression is becoming more salient. If you have an interest in having an active manager who's been doing it over 30 years, who's here every day trying to protect and profit from all macroeconomic conditions, then you found that person in Pento Portfolio Strategy.
Well, we're always grateful for your perspectives and your insights here that you share with our viewers when we have you on Liberty and Finance. And folks, so that you don't miss a single interview with Michael or any of our guests, make sure you go to libertyandfinance.com. Over in the left-hand margin, just put your name and email address, click submit, and then make sure you confirm when you get a confirming email from us, and you'll have an email in your inbox every day with our latest interview, including every interview with Michael. Michael, as always, on behalf of all of our viewers, thank you for joining us on Liberty and Finance.
Always great to be with you. Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.